Right, brilliant. So, hello everybody. My name is Adrian Boothby. I'm the head of trading here at Trend Signal, and it's the 4th of November 2019, and it's the Trend Signal podcast. And there's loads of stuff to get through today. Big week last week on the markets, and lots to talk about on the impact. The equities rising, new highs on the Dow, new highs on the S&Ps, and lots of movement there to get our teeth into, and lots to talk about as well. Now, today I'm not joined with Jerry because my partner in crime, if you like, he's actually climbing base camp in Mount Everest there. So he's actually on his way there. He's probably started with his crampons already, and he's getting out there and doing it amazingly. But what we do have over the next week or two is some guest speakers. And I'm delighted to say I'm joined with by Gurpal Singh, who works for TMS Capital. Gurpal, you want to say hello?
Thank you very much, Adrian. Yeah, welcome on board. Thank you very much.
So we're going to get Gurpal online in a few moments, a few minutes time for our main topic for today. That'll be after about 10 minutes there. And we're going to be talking about how you choose a broker. Gurpal's been in the broking business for donkey's years, and he's going to be giving us a wealth of his experience once he comes online a little bit later on. Okay. And now, guys, before we do get into it, if you are listening to this live, then please get into the questions box. You can type something in. We want to make this as interactive as possible. Type something in now, please, in the questions box, just so I know we're not talking to ourselves. But also, there is going to be some polls today. We want this interactive, and we want you to know how to get involved as well. And you can ask your own questions too. If you're listening to the recording of this, well, do you know what? Get yourself registered and attend it live. That really is the best way of listening to this and getting as interactive as possible. So let's get into it then, shall we? What happened last week? Well, look, there was a big rise on the equity markets last week. We can see that on the charts here, just looking at the Dow. We've really moved into new all-time highs on the Dow and with the S&Ps as well. And in fact, if I look at the Dow, we can see we had a little continuation trade last week there. I won't get into the sort of details of that right now. We actually closed that trade a bit early, making some profits before its natural target. And we did that simply because, and I know we talked about this last week, because we had FOMC, we had that interest rate decision by the Federal Open Market Committee last week there. So really, just to reduce risk a little bit, we wanted to get out of that trade just a touch early there. So, but it's fine. I love the trade. I'm very much more of a bull on the equity markets. And we're going to talk about that a little bit later on. Am I a bull up here? We're going to get into that. I'm going to talk about something called the VIX a little bit later on. And we're going to get into some really good stuff as we go through this session. Relatively flat on the FTSE though last week and small up on the DAX. Actually a really strong, about 17-month highs on the DAX. We're just moving into up another 140 points or so today. Massive move there on those equity markets. And again, we can talk a little bit about why that's happening later on. So in terms of last week, we had an interest rate cut over in the US. What did that do? Well, as you might think, that did lead to a bit of a rally on the stock market there. You know, cutting interest rates right now is making stocks more attractive because ultimately there is nowhere else for anybody to put their money. We've talked about this in recent weeks. People, major investors, pension funds, hedge funds, and so on, they're going to invest in currencies, they're going to invest in bonds, they're going to invest in stocks. And actually, there's no point investing in bonds right now because the returns are so low. Interest rates in Europe, in the Eurozone, 0%. In the UK, 0.75%. An interest rate cut in the US down to 1.5% or so. The point really being, any cut is making bonds less attractive. And really, where else are these institutions going to put their money? They're going to start putting them more and more into equities. And even though you're seeing equities rising and rising as they are right now, equities are still attractive even at these levels. We've got to talk about earnings in a second, but the fact of the matter is that there are still some really great dividends out there at the moment, some great yields and some great dividend cover as well. So talking about dividend cover, what is dividend cover? Well, you may know if you're buying stocks often, unless they're a growth stock, stocks will often pay out a dividend, and that's how they distribute their profits to their shareholders. And they'll do that depending on how they're listed. They might do it quarterly, they might do it half yearly, They might do a special dividend from time to time. Some companies don't pay any dividends at all. Maybe that's because they're not making profits, or maybe they're just reinvesting their profits into the forward growth really of that business. But the point about this is really that at the moment there are still some great yielding stocks out there. There's still some value out there. They're not exactly overvalued, even as we move into all-time highs on the US stock market there. Me, I manage a stock portfolio. One of the things I do is I look at income, I'm looking at dividends, I'm looking at yield, I'm looking at dividend cover. Do we all know what dividend cover is? If you don't know, dividend cover is basically how affordable a dividend is for that company. So a company has their earnings, their profits. They give you a measure called earnings per share. Effectively, the earnings per share divided by the dividend, in other words, the dividend paid per share, gives you the cover. How much of their profit have they got to cover the dividend? Anything with a dividend cover of more than, say, 2 times means that they've got plenty of cash and profit in reserve based on what they're paying out. So effectively, there's still plenty of stocks out there which have a high dividend cover, which means they can afford to pay out their dividends, and they're paying out decent yields, 5-6% and so on. So there's good, attractive stocks out there, and really one of the reasons why equities continue to excite as a comparison against bonds, which are becoming less and less exciting as interest rates continue to be cut, as we start to talk more and more about recessions and so on. There's a few stocks reporting this week coming up. Disney, I was going to talk a little bit about that. I'm not going to talk about it. It's the only Dow constituent reporting this week. That's going to be important because with the only Dow stock this week, there is talk about earnings. Earnings are slipping a little bit in the US compared to where they have been in previous quarters. There's going to be a lot of focus on that one. However, with Disney, a lot of forecasts, the forecast information is going to be important as we start to think about, their new Disney streaming service. Are you going to subscribe to that, Gurpal?
Absolutely, a big fan.
Yeah, it'll be interesting. I don't know. There's Netflix now. There's Amazon Prime, Disney Plus. It's not launching for us till next year, I don't think. But anyway, who knows? What we'll see. In terms of the dollar, overall the dollar fell last week. The biggest day, of course, being on Wednesday after receiving confirmation of the Fed rate cut on Wednesday. It was pretty likely. In fact, there was about a 94, as we started the week, there was about a 94% likelihood that there would be an interest rate cut in the US. There was one. It did happen, and that led with a positive move on equities on this day here, as you can see, but also a move on the Dow, a move on the dollar, falling the dollar as well on that Wednesday too. Okay, in terms of economic data for last week, it really was a very big week there. UK-wise, perhaps not economic data, more political perhaps. After failing to agree Johnson's Brexit deal, a general election has now been agreed for the 12th of December for the UK, which I think it's the first December election ever for the UK. Might be quite interesting given the cold weather. Is that going to keep a few people away from the polls? Who knows? But certainly the race has already started with Parliament breaking on Wednesday this week, which is going to allow for 5 weeks of campaigning. And actually, to be honest, it's already started. I'm not going to make this a political podcast or broadcast, but safe to say the usual topics of the NHS, the economy, and Brexit is all at the forefront of those campaigns already. Johnson has rejected Farage's offer of an election pact, although this was conditional on Johnson dropping his deal and pushing for a no-deal agreement and pact there. The danger, of course, by rejecting an election pact with the Brexit Party is effectively that's going to water down the leave voters, and that might actually allow a way through for Labour and for a Corbyn government. Who knows? We'll see. There's certainly a lot to talk about over the next few weeks. And actually, there's going to be some great movement on the markets as we pick up who's more likely to go through with that general election there. There is talk about tactical voting, but again, let's not make this a big political thing. Certainly for us traders, I dialed back to 2017 when we had that the last election here in the UK. One of Labour's manifesto pledges was to talk about something called a transaction tax on traders for us traders there. I, for one, don't want a transaction tax on my trades, but I don't know if it's going to be in his manifesto this time, but who knows? We'll have to see. But look, let's get back on with the markets then, shall we? Japan maintain their short-term interest rate of minus 0.1%. And in the US, we can see for last week here, quite a few things there. ADP data, so we talked about this last week, as sort of the flag ahead of the more important non-farm payroll on Friday. This was bang on expectations there ahead of the interest rate decision on Wednesday night, which was an answer to cut those interest rates there. We saw that separately. That was as expected there, and we've seen the impact that that had on the markets, of course. And remember, when you cut rates in order to stimulate the economy. It makes saving less attractive. What that does, it gets people out there spending more in terms of the global macroeconomic policy. What that does is it makes the US dollar more attractive. So therefore, what that's going to do is you're going to buy dollars. Dollars are more attractive now because of that rate of return. That will then lead to a rise in the dollar, all other things being equal, by having a cut in interest rates makes the dollar less attractive, I should say, and we saw those moves on the markets last week. And actually, what we're going to see as well is, in terms of the likelihood of interest rate change going forward, the next rate decision in December there is only a 5% interest rate cut chance in December. This is actually quite a bit less than it was before, and I think the reason for that, guys, is down for the non-farm payroll last week. Non-farm payroll was very, very strong. We're expecting 90,000 jobs created. There was 128,000 jobs were created on in Friday's data. Plus, probably more importantly, there was a revision to the previous 2 months with a further 90-odd thousand. I think it was 95,000 or something like that extra jobs realized or created from those previous months once they'd extrapolated and corrected that data. So that was really important there, putting the economy in a better position than we thought it had been before, making actually less of a requirement perhaps for a rate cut as we go through to December as well. As for the week ahead, well, this week it's relatively quiet. I mean, it really was a lot last week. This week ahead, relatively quiet there. One thing we did have was, in the US, they changed their daylight savings there, which is meaning that markets are back closing at normal hours. So if you're in the UK, we changed our clocks the week before. US changed them on Sunday, which means we're back to, 10 p.m. closing times for most foreign exchange markets there. I know it's 24-hour, but have a natural sort of cut-off. The US markets were opening at 1:30 last week. Now they'll be opening back at 2:30. Same thing with the major economic data as well. Typically 1:30, 3 o'clock. Again, it'll be back to 1:30, 3 o'clock for this week, and really until March, April, and beyond there. So in terms of major data points this week, it is relatively quiet. There are a few bits to keep us interested, though. Australia, they've got their interest rate statement. We're expecting a no change over in Australia with their interest rates. Again, 0.75%, very, very low interest rates globally, really. German manufacturing PMI, where have we got that? For some reason, I think this is only seen as a yellow number in here. This is going to be important because we start to move towards working out whether Germany is going to be in that recession or not. We're getting towards that time there. And again, this is all important for the Eurozone and what they're going to do as well. So working out what their manufacturing is. And manufacturing in Germany is pretty big deal, okay? Obviously cars and so on. So there's going to be a lot of eyes on that data as well from Tuesday. Oh, sorry, that's today. What am I talking about? That's already happened. I'm going completely mad. Okay. We've also got crude oil come out. Let me just refilter that. Bear with me. Hang on one second. We've got crude oil data on Wednesday, crude oil inventories there. And also in the UK, we've got our interest rate decision. Look, not really expecting any change there on Thursday, but all eyes will be on that, of course, and the impact it will have on the pound. And of course, now we've got the Brexit really kicked into the long grass for a few months at least. it really is making the pound a little bit more interesting to trade now, a little slightly less erratic than it might have been for any shock Brexit news or announcements there. So I think we're more likely to get a normal pattern of play on the sterling markets there, but Thursday is a big news item, so keep your pencil sharpened there for Thursday for any movement there on the pound. Okay, and then finally, really what I wanted to talk about is get a little bit more into what's happening with the markets as well before I bring Gurpal on there. We talked about earlier the likes of gold. Gold really stuck in a very narrow range and has been for a month or two now. Really, we'd like to see gold start to break out sort of above that 1530 area or sort of below that 1450 area there. So keep an eye out for that over the next couple of weeks. It really is in a very tight range. These sort of low highs, higher lows, really contracting this market up. So I think we can expect hopefully a few fireworks over the next couple of weeks there. Stocks, like I say, equities continue to be extremely high. And the reason for that we've already gone through, and a lot of that actually is down to interest rates being as low as they are. Interest rates being cut by the US last week, but also if you think about it realistically, if interest rates are extremely low, if data is getting worse, if Germany is going to go into a technical recession, they can't really cut interest rates any further. So what's likely to happen, you might get something called QE coming back again, asset repurchasing, which is only likely to be positive for equities. So it's really, really interesting time right now. The question is, guys, is now the right time to be buying stocks? With Germany, S&Ps at these massive highs, one thing I wanted to do today, and we'll try and go through this relatively quickly, was bring in a comparison between the S&P and something called the VIX. Now the VIX really gives us something, people call it the fear gauge. Has anyone here ever heard of the VIX before? Let me know in that questions box, please. The VIX gives us an idea about how complacent or fearful the market is. Effectively, what the VIX basically tells us is this. When the market is very low, like we're seeing at the bottom here, let me just bring my spotlight in, very low like it is right now, that's basically telling us the market is complacent, and all we're doing is talking about rising stocks and how wonderfully positive the stock market is. And of course, really, we should be doing the opposite of what most people are thinking, shouldn't we, as traders? And in fact, when the market is high, when the VIX is high, that's telling us how fearful the market is, how much we're panicking about stocks. Me personally, longer term, I'm a bull on the market. However, in the very short term, I'm not convinced I'll be adding to my stock portfolio right now. And the reason for that is ultimately down to where we are in the VIX. And I want to show you something, guys. I'm having a couple of people saying they can't hear me. Can you hear me, please? Let me know in the questions box. Just type yes in that questions box. Thanks, Natalie. Okay, the reason why I'm not so bullish up here, I am longer term, but not up here, is because of the VIX. Let me show you something. Down at 12, where it is now, you see my spotlight, the last time the VIX was down at these levels, i.e. complacent and so on, this is what happened to the stock market. Let me show you. We got down to that level of 12 here. Look at the chart at the top. You see how high it was up here? That was the S&P stock market. And look how much we fell. We then had about 5 or 6 days of manic selling and fearful selling as well, as everyone panicked out of stocks. This is where we're at now. That's not to say it's going to happen anytime right now, but I think there is a danger of us getting towards that. Let's have a look at the previous time we got down to around 12 on the VIX. It happened back here in the middle part of April. Okay, so it took a few days for that fall to happen. But a few days later, suddenly we then had a massive fall on the S&Ps again, moving to the bottom of its natural trading range once, twice, again, all from a position of around 12 on the VIX. This is where we are right now, guys. Next, let's have a look at when we last moved down below that level, which was back in October 2018. What happened in October 2018? Well, let's put the timing. Let's have a look at the lows. We saw this move start to happen, okay? Do you see where we're at? We're in a position now where something might start to happen on stocks. And yes, maybe a catalyst might be some poor earnings coming through. Who knows what the catalyst might be? Ironically, Often good news can be a catalyst for a fall in stocks because there's nothing left to get excited about. That's the last bit of good news. It's locked in. We know it now. What else is there to look forward to? The point really being, I think there's going to be some opportunities coming up on those equity markets. And the fascinating thing about all of these is you need to be able to pinpoint that timing, like we did in May, like we did in October, like we did back in, where was it? Here, back in the end of July. Fantastic turning points there and fantastic trading opportunities if you're able to spot those turns. But realistically, with the VIX at the levels it is at now, it could well be that over the next couple of weeks, we're going to have a good, 5, 6, 7, 800 point fall on these markets. So keep your pencils sharpened, guys, okay? And of course, the thing about this is it's all well and good knowing about this stuff, but where are you going to place those trades? And that's why I've got our guest speaker, Gurpal Singh, in with us today, who's going to talk to us about our topic today, which is how to choose a broker. So Gurpal, thanks so much for being with us today. Sorry, I was talking for a lot longer than I was expecting to, but introduce yourself. Tell us a bit about yourself, Gurpal.
Well, first of all, thank you for having me on board today, Adrian. Look forward to sharing some of what I've experienced. And Adrian's quite, he's sort of half right. It does seem like donkey's years since I've been in the market. I've in fact been sort of involved in the industry now for almost 18 years. Sort of as a fresh-faced individual, I first started work at IFX, which was primarily a market maker for financial currencies, really. I stayed there for a couple of years and then moved on to more of a retail type of broker with FinSpread. Some of you may have heard of FinSpreads and City Index, and sort of spent quite a few years there really understanding the markets and finding more about what trading is about as a whole. And then obviously from there I now find myself in my current position at Twowaymarkets, which brings me here. So yeah, I've had some pretty interesting years in the markets, and I've seen some interesting moves over the last few years where we've seen, of course, events unfold that have changed some big moves in the markets there.
So what do you do now then? So you're not working at a London broker now. So what are Twowaymarkets?
Yeah, so Twowaymarkets, we essentially we have relationships with sort of primarily UK based platform providers, and my job here really is to find suitable sort of platforms for individuals out there. I mean, I speak to clients pretty much on a daily basis, and the one thing that's very apparent to me, not everybody has experienced, not everybody has been sort of trading for a number of years. We've got a lot of clients who are very new to it, and of course these platforms are different. Some people have got different needs and wants, and my job is really to make sure that they feel comfortable with the platform they're using, and of course they're trading in a safe environment, which they are trading.
Safe's important, isn't it? I mean, you know, security of funds. I mean, there's been a lot of talk on regulation lately, and there always is, to be honest. But there's been companies that have. I mean, I'm sure you've had a few horror stories of brokers sort of not releasing funds and all sorts of stuff.
It is. I mean, I guess as financial institutions, they're all vying for your business out there, and I guess, you know, with that comes sort of companies out there vying for, you know, giving you sort of promotions and all sorts of promises of X, Y, and Z. But from a customer point of view, it's imperative that your hard-earned money is placed with a broker that is in fact regulated. And
why is that important?
Well, of course, your hard-earned money, you've got to be able to access that money, and you've got to be able to withdraw that money. So here in the UK, we're regulated by the FCA, which is the Financial Conduct Authority, but there's regulators throughout the world. We've got the ASIC, which are based in Australia, CISEC, who are Cypriot, and we have the NFA and the FTC, who are the US. So they're all sort of regulated bodies who govern, and they themselves are sort of made sure that they behave in a certain way and that they protect clients like myself and your viewers here today.
Have you spoken to many people that trade with unregulated brokers?
Yeah, I mean, unfortunately, for every good story you hear, there are the horror stories that we come across, and individuals who pick up the phone to sort of silky salesmen who promise all sorts in the markets and returns, and although they sound like they're calling from a UK operations, more often than not, they're sort of calling from places like the Caribbean and the Grenadines and places like that. And of course, I've come across clients who have actually just given away lots of funds in order to hopefully receive good returns for those, and
they just disappear.
You know, they're not picking the phones back up, and they're finding it incredibly difficult to take their funds back out.
Yeah, that's not really what we want to get into today, is it? That's horrible stuff. So look, what I want to do is just try and get into a bit of a poll, guys, please. So one of the benefits of being in the live sessions is you can get involved in these polls. I've got a couple of questions I'm just going to put out to everybody there, and you can click on your screen to answer this question. So please, everybody, answers on a screen near you. What's most important when you choose your broker? I want you to just click on, please, what you consider to be the most important element when you are choosing your broker. Is it regulation and security of funds? Is it the platform and, let's say, the ease of use of that platform? Is it the spreads and the costs and margins? Let me know, please. Or is it actually some other added features? Do you want added value features that, you know, that the broker is making available to you to improve your experience there? So what would you say is probably the most important part there? Again, guys, make sure you get in the questions box to make it as interactive and as participative as possible, please, guys. Regulation. Funny enough, I was actually expecting spreads and costs, margins to be the most important one for people. But I suppose actually, if you think about it, Gurpal, most of these brokers are pretty much offering the same spreads these days.
They do. I mean, since obviously competition is so rife, spreads are really much not a bone of contention for a lot of brokers. They pretty much are.
10 years ago, it was very different, wasn't it? There really was a lot.
Absolutely. I mean, I noticed. I mean, regulation is high on the list for your listeners here today, and I mean, just to add on what I was sort of saying, I mean, in the UK with the FCA, if you are with a UK broker, which primarily we do deal with, I mean, you are protected under the FSCS, which is the Financial Services Compensation Scheme. So £85,000, should any of your listeners want to deposit that type of money, is fully protected under that scheme. So if you have a customer account with a UK FCA regulated broker, whatever happens to that broker, your funds are protected up to that amount.
That's quite a big deal, isn't it, actually? I mean, you know, the funny thing is, I mean, it's not just that. We'll talk about other ways in which to secure your funds and be more protected. I've got one more question, guys, for the poll, actually. I'm going to put that out now. So what type of brokers are you currently trading with? Are you currently trading with a UK regulated provider, a non-UK regulated provider? So this would be for CFDs or spread betting. Are you perhaps just trading with a stock broker? Are you trading with an unregulated or crypto or binary broker? Or are you not yet trading CFDs or spread bets? Why don't you let me know in that box as well, please. There, you can click on your screen. If you don't know quite what you're doing, you should see on your screen it's popped up. You can just click on that one. If you're in the recording, well, sorry, it's a live session, so get to the live ones in the future, please. A bit of a variety of responses coming through. What we'll do, let's go through some of these then. So, Gurpal, you've talked about the different regulators that are out there. You know, I think it's safe to say not all regulations are the same, but there is a certain quality of conduct from them, isn't there? Yeah. But I think one of the things, we talk about regulation, the way they're going to reconcile money, client money, how they handle client money is really important as well. So you can talk about, they talk about something called segregated or non-segregated accounts. What's that?
Absolutely. So as Adrian has just pointed out, segregation and non-segregation. I mean, with unsegregated funds, you'll find that it's one part. So actually that company does have access to all the funds. So you might be putting your funds in and they treat everyone's funds in one particular pot, and some may feel that uneasy about that. So with
what that means is that when you put money into your account, you think it's going into your account, but actually they may choose to then go off and spend that money or use it for their normal business. Maybe they use it on offers, maybe they use your money for running their business, maybe for advertising. Who knows what they might be using it with. So having your money segregated away from company money is quite a big deal in a special client account.
And most UK brokers do actually now do offer segregated, and if your broker isn't, certainly it's a question or something for you to consider. Segregated funds, of course, whatever money you put in, it's your separate money. That's separated from any business activities, from what the broker would need to. So it's safer, certainly.
And I remember when I used to work at Grant Thornton Asset Management, I actually did the reconciliations every day. It was a pretty painful job, but you got to do it. Someone's got to do it. And we had to reconcile every day. We had to balance every single penny every day to make sure that the money was in there as per the client deposits. And if it wasn't, then you had to let the FCA know. And if you couldn't meet that shortfall because the company didn't have any money left, effectively the the regulator was informed, and you had to stop trading. And it was, but the point being is that those protections are in place, and that's what you get from a top grade A regulator rather than some of the other institutions that might be out there, perhaps.
And also with the broker themselves, Adrian, I mean, counterparty risk is important. I mean, there are lots of providers out there who are offering their sort of services, but you've got to ask yourself how liquid is that company, how strong are they, have they been around for a while, how stable they are. I mean, we work with a number of brokers ourselves, as I mentioned earlier. I mean, IG, one of the market leaders, they're worth over $1 billion. So there's no problem with market sort of risks there. We've got markets.com, who are owned by a company called Playtech. They're worth over $1 billion themselves. So again, two of the big powerhouses there. And
that's the thing, isn't it? Because I suppose it's all well and good having the financial services compensation scheme there, which is great. But the question is, how likely you're going to have to use it. You still don't really want to use it. It's nice as a worst case, isn't it? Well, and it's nice to know your funds are protected to get it all back. But it's a bit of a pain in the proverbial to have to go through it, isn't it?
Well, you don't want to open up a trading account and 3 weeks later, all of a sudden the broker's closed its doors down. And, you do want to look for a feasible broker. I mean, ETX is the other one. They've been around for a long, long time now. They've got a good record for customer services. So, it's about using your common sense, finding out where brokers are with what they offer and how long have they been around. And, in my view, people, they work hard for their money, and it's so easy to be lured in by fly-by-night brokers and just to be putting in your funds and when someone you're not too sure about. So do your homework. It's important to find out where you're putting your funds.
I think that, I can't remember the exact numbers, but I think in the UK, if you want to hold client money, if you want to be a broker and hold client money, you can get a certain category license where you only need like 200,000 or something like that in there to hold clients' money. 200,000, I mean, that's nothing really if you think in the grand scheme of things.
No, I mean,
and people probably don't ask the questions about what's the company worth, what's the balance sheet, how likely are you to go bust? Well, if all they've got is 200 grand in there, they've got all their other costs, there's a bit of a risk of it. And I think if there's another category where I think you need 750,000, which is a lot of money, don't get me wrong, but if you've got client funds of 30, 40, 50 million, it's not really a lot either, is it? So it's interesting, and I think one has got to really be careful about having that compensation scheme protection in place. I think the FCA is actually the best globally, isn't it?
It is, I would say. I mean, we can be biased here, obviously sitting in the United Kingdom, but the FCA, they are very strict in their operations. I mean, each of the brokers that are offered to the public, they themselves are restricted in terms of how they promote their services, how they communicate. I mean, your listeners today, you'll be happy to hear there's a course of complaint procedure, so you're protected if there is any grievances. You can go to the Financial Ombudsman Services. So there's a course of action, whichever these brokers are policed correctly and they're tightly looked at. And again, your funds are protected. So it's the best way. So if you've got a broker out there that's outside the UK, maybe they're not looked as tightly as maybe the FCA certainly govern themselves.
Yeah, absolutely. Something to consider. And okay, so what else do you look at with the brokers? Is your main focus looking at what platform ease of use, or what is it?
Yeah, of course. I mean, adding value to the platform is key. And as I sort of mentioned earlier, we do have a wide spectrum of experience and market knowledge. And of course, providing a safe environment is key and paramount, but giving clients a sense of flexibility and not being overburdened by having to sort of outlay thousands upon thousands of pounds just to try the markets out. my job here is to make sure you feel comfortable in your trading. So with a lot of these broker platforms now, Adrian, you can actually trade all the way down to sort of 10p a point. So you're literally trading in pennies, if you like.
It's funny, actually. You sort of go back a few years ago, and it was really the minimum was what, £1 per point.
It was, and a pound doesn't sound a lot, does it? But
it doesn't.
When you can consider the Dow Jones, even today, it's up 150 points. It can be considerable.
It's effectively £1 a point. That's what, a 25, £27,000 position. I mean, you know, the S&Ps, that's a £30,000 position. Yeah. It's quite a lot. So to have that flexibility to trade smaller is pretty attractive, I think.
So if you're new to it, you don't need to be daunted by it. You can actually, outlay a relatively small pot of funds and dip your toes into it, really, and trade very, very small and actually progress from there. We always encourage the people progress. People learn, and it's the best way to learn when you feel less nervous and less pressure on you, and it's a great way. I think it's a good thing that the brokers are giving these sort of flexibilities. Yeah.
I think if you can start small, get it right first. Get your tools under your belt, get your experience, get your strategy, get confident in it. You can always grow your trade size from there, can't you? That's the easy bit.
Absolutely.
Get the strategy right first.
And nowadays, the accessibility is absolutely outstanding. And of course, with technology now, you can access your broker platforms through your phone, your Apple or Android devices, with tablets. So, it doesn't matter what you have, you can access a trading platform in order for you to place a trade, and they're pretty much 24 hours a day now, and a lot of these desks are manned 24 hours, so you can actually access their charts and any other sort of information that you require, so you can trade throughout the clock and throughout the year practically.
It's funny, I think one of the things I've noticed over the last 18 months probably is that brokers are starting to add more markets onto their platforms than perhaps ever before. A lot of them were just straight off forex. Now they're adding those indices in there, there's commodities on there, maybe equities as well. You're starting to get more market coverage just to differentiate themselves against the normal broker, because actually they can't really compete on spreads anymore. They can't really compete on margins. Really, they compete on where they're regulated, I would say, the security of their funds, the security of the company, and also the markets and the added value, ease of use of platform.
Absolutely. Obviously with the popularity of cryptocurrencies there in the last year or so, they've come on board. A lot of people you can actually trade down to a penny a point, would you believe, on things like Bitcoin, on places like ETX. So, of course, the market ranges are now, so if you're more sort of traditional stocks and shares, you've got a whole array of stocks and shares now, which people like IG and markets.com, not just UK companies, but pretty much any company out there, any country out there, you can pretty much trade on those stocks. And
so you go long and short, you can trade on margin, you can do all that. It's so much more flexible than it ever used to be, isn't it? I remember when I first started, my first job at a stockbrokers in Northampton was, it was literally as CFDs were just getting started. The whole concept of short selling was all a bit weird for some people, but actually the way we were trading back then was something called extended settlement. You'd buy a stock, you'd have normally 3 days to pay that money up. But actually extended settlement, you'd get 20 days to pay it up, and people would trade that. They'd have to close their trade inside 20 days. Well, but now, obviously, you can trade whatever size you want. And
absolutely, with the way leverage is nowadays, of course, with the old, if you're sort of traditional buying and selling shares, you'd need quite a substantial amount of funds at the ready to cover your cost. But with the way leverage is, and obviously with things like spread betting now, and that is probably the most keenly way most people do trade here in the United Kingdom now. Of course, you've got the tax-free element to it, which is always advantageous, but you don't need that level of funds at your disposal in order for you to trade those sort of leverages that you would do in traditional sort of stocks and shares type of
I think the platforms have really simplified as well, haven't they?
Yeah, absolutely.
The order types, you used to have carry around a dictionary with you the whole time to work out what the bloody orders all meant. It's a lot more straightforward.
It's straightforward, and part and parcel of our job is to make sure it is easy for you. We run through client platforms with clients. We make sure that you feel comfortable.
One-to-one
Absolutely.
sessions,
So if you're very new to it and you'd like someone to actually hold your hand and actually go through it with you, that's what we're here for. A lot of the times these brokers, they're so busy on the desk, they simply don't have the time or day to sort of ask those mundane or simplified questions that people may have. So give us a call, we'll go through it slowly. We'll show you how to place trades, show you the order systems and get you comfortable, and in order for you to really get going with it.
It's funny actually, just thinking about that for a second. This is not something we've discussed actually, Gurpal, but with the regulation change, with the margin changes last year, a number of brokers are really sort of reducing their number of staff. They really are on a bit of a cost-saving exercise at the moment. And I'm sort of wondering there, listening to you, about whether you think that there's going to be a lot less of that support going forward, a lot of that support, the hand-holding, the reviewing of people's platforms, making sure they're okay. Do you think the service element is going to reduce from these brokers?
Perhaps. I mean, obviously with ESMA, which is what Adrian's sort of referring to, last year we, of course, the European sort of regulators have sort of now tightened their belts in terms of how much individuals need in terms of funds. So I guess brokers' focus is literally more on education now.
You're probably finding their focus is more on the bigger clients, which might actually lead to the smaller client being a little bit more isolated, perhaps.
Absolutely.
Which would be a shame, actually, I think.
It can be, because I guess they know they want to make money, so they'll look at more high net worth individuals. So those smaller clients, of course, probably be sort of left to sort of fend for themselves. I guess that's what we're here for. We're here to help everybody. It doesn't matter whether you want to put in £500 or £5,000. You've got an interest in the markets, you'd like to trade, but you need more help in terms of how to operate those systems. It's important that everyone gets the same sort of level of service.
Yeah. Okay. Well, look, that's I think what I'd like to do is sort of finish up now, Gurpal. Before we do move on, just to really sort of reiterate what Gurpal's saying there. One of the things that he and his team do is they sit down with traders and go through, help them choose the best broker for their needs, the one that's got the best security of their funds, one's got the best ease of use for the platform, and really is tailored to the type of trading that they want to do. FCA regulated and everything. Now, without making this a bit of a sales pitch, because that's not what this is for, but if you would like to get in touch with Gurpal at Twowaymarkets, how can they do that, Gurpal?
Yeah, sure. Well, listen, I'll give you my own sort of email address, so you can get in touch with myself. So it's Gurpal, and that's Gurpal .Singh, that's SINGH, at tms-capital.com. And I'm sure Adrian will provide you with guys a link, and you can always give us a call. Our direct number for the team is 0207 077 099 113. I'll just reiterate that. So it's 0207 099 1138. So I'll be more than happy to sort of schedule a one-to-one, or if you've just got a random question, don't be afraid, give us a call. We'll be more than happy to accommodate.
And it's free, isn't it? So
of course.
How do you get paid? The broker gives you just a little bit of the...
Well, yeah, well, the broker, of course, we introduce clients to various different brokers, so we've got no bias in terms of who we introduce to. But if we do introduce client accounts, the broker gives an introductory fee in terms of some of the spreads that clients may trade on. So that's how we get remunerated. But essentially, it's important that we get your customers in with the right broker so they feel comfortable in placing trades going forward.
So it's a great service, cost the client nothing, and they get a much better level of service.
Absolutely. So any problems going forward, you always have a name and a number to come back to us on. So we're here to help and make sure it's a smoother ride as possible.
That's great. Well, look, we've got Anastasia asking for a link, so we'll get that over to you, Anastasia. Thanks very much for that, guys. Look, I'm going to call it an end to the live session, but that was great. I enjoyed today, and hopefully you learned something in today's session. Thanks very much for Gurpal for joining us.
Thank you.
And next week we'll be I don't know what we're going to be doing, but we'll send an email out on Monday about what our main topic will be next week. But hopefully there's going to be some fantastic content out there, a few new polls, and lots to get our teeth into for the markets for the week ahead. But thanks very much for attending today. Have a great week's trading, and I look forward to catching up with you next week. Bye-bye for now.